चेक। हाँ जी दोस्तों, क्या हाल है, क्या हाल है, क्या हाल है। आई होप यू आर ऑल डूइंग रियली रियली वेल। दोस्तों, guys, welcome to this code revision which is specially for you all, which is going to be in 100% English. Okay, guys, before I start the session, let me tell you something very important. I am bringing code revisions for each and every chapter of law in the shortest time possible. So basically, this is a revision which is absolutely relevant for your last day revision, for your exams revision, and whenever you are preparing, it is always relevant. It is not a replacement of the regular exam-oriented batch that we have. But yes, for those who have already done studying, for those who have already started reading, for them this revision is going to be very, very helpful. Okay. GOAT revision playlist is there in my. There are three things that I want to tell you. Number one, so the notes that I will be using for this revision and the question bank that I have is something which is a must buy for you. It is a must buy product for you because in just 200 pages, I have summarized the whole syllabus of CA intern law. So it is going to be very efficient for your last day revision. So this book you can purchase from the link given in the description. You can either visit shubhamsinghal.com or Shrestha for CACMA. That is where you can get this book for just 700 rupees. Point number two, sir, please understand that there is a chapter wise revision, so you can find the playlist of this revision in both the channels Shubham Singhal as well as Ram Harsha sir's YouTube channel. And the third thing is, along with these questions, I would want you to go home and solve the question bank also, so that you can have better grip over the content. You can have better grip over the content. Are you with me, guys? Yes or no? Are you with me? Yes, sir. All right. So now, let's begin the revision without any further delay. We will divide this revision into two parts. Today we will do part one, and the second part we will do tomorrow. So, guys, share capital and debenture is a very important chapter and can come in your exam for up to 10 marks. All right, guys, share capital and debenture. Let me tell you, it starts from section number 43 and goes up to section number 72. Okay, what is section number 43? So, let's start first. Section number 43 talks about share kinds of share capital. As you must be knowing, there are two kinds of share capital. One second, I cannot see your chat. I don't even know if you're active here. Mm. Yeah, I can see myself. If you could just confirm once everything is fine. One second. Okay. It looks like everything is fine. Okay. Sir, so coming back, listen to me very carefully. Section number 43 talks about kinds of share capital. Listen to me. Sir, what are the kinds of share capital? We know that there are two kinds of share capital. One is equity share capital, one is preference share capital. So when you say preference share capital, what is the preference that we are talking about? When we say preference share capital, we are talking about basically two preference. We are basically talking about preferences with respect to declaration of dividend, preference with respect to repayment of capital on the winding up. There are two preference. Number one, before equity shareholder, you will get dividend. And number two, in case of winding up, before we say pay to the equity shareholder, we will repay to the preference shareholders. Are you with me? Yes, sir. This is your point number one. Sir, what is equity share capital? Sir, equity share capital can be of two types. One, there is normal equity share capital with voting rights. The other one is equity share capital with differential rights, which we call as DVR, differential voting rights. The difference could be with regard to dividend also, voting also, and any difference. Like there could be any difference. For example, there is class A equity share and class B equity share. So class A has one share, one vote. Class B has 10 shares, one vote. This is called as differential voting rights. This is called as differential voting rights. So there are differential voting rights, equity shares. So basically that is what about equity shares. Now listen to me very carefully, guys. Sir, point number one. In capital, sir, if for example I told you in preference shares there is dividend, there is preference of two things. Number one is dividend, and number two is repayment or winding up. Correct? Repayment or winding up. My question is, sir, if I issued a share capital in which there is a preference of dividend but no preference on repayment, or there is a preference on repayment but no preference on dividend, will it be considered as preference share capital? The answer is yes, sir. Law says that even if there is one preference, it will be considered as a preference share capital. Capital shall be deemed to be preference capital even if it has either or both the rights. Either or both the rights as preference, it will be called as preference share capital. Okay, guys. Now coming to the next point, please listen to me very carefully. Sir, now the question is, can a company issue shares with differential voting rights? Can a company issue shares with differential voting rights? And if yes, what are the conditions? Sir, there are seven conditions that you have to remember along with me. What are the seven conditions? Sir, condition number one, it has to be authorized by the AOA. You will remember along with me, and then we will write it roughly once, but remember along with me seven conditions. And number one, you have to authorize it in the article of association. Number two, it has to be authorized by an ordinary resolution at the general meeting. You will have to pass an ordinary resolution at the general meeting. But listen to me, if you are a listed company, then you will have to pass such resolution through a postal ballot. Although ordinary resolution only, but it will be passed through postal ballot. So postal ballot is something that you study in section 110. So you will pass it through a postal ballot. Number three, sir, the voting power on these DVR shares. Voting power in this DVR share shall not be more than 74% of the total voting power. So if this is the total voting power, sir, so the DVR shareholder can have maximum 74% of voting power, not more than that. Point number four, sir, the company shall has not defaulted in filing of financial statement and annual return. They have not defaulted in filing of financial statement and annual return for three immediately preceding financial year. Financial statement and annual return for 3 years, they have not defaulted. Point number five, they have no subsisting default in what? In, sir, dividend, deposit, preference share, debentures. They have no subsisting default. Everything that is due, they have repaid. The next point is company has not defaulted in dividend on preference shares, repayment of term loan, statutory dues of employees, and crediting amount to IPF. These are four new points. What is the point number five? Point number five says that there is no subsisting default. Subsisting as in continuing default. Point number six says that company has not defaulted in these things, and provided that company may issue DVR after expiry of 5 years from the end of financial year in which default is made good, after you renew it. And last, it has not been penalized by any court or tribunal in the last 3 years under any act, RBI Act, SEBI Act, FEMA Act, any act. So basically, sir, if you read along with me and if you write along with me, there are seven conditions. Write down carefully. So there are three conditions. Number one, AOA. Number two, you have to pass ordinary resolution. For listed company, it has to be postal ballot. And number three, maximum 74% voting power. These are the first three conditions. AOA should authorize. Ordinary resolution has to be passed. And in case of listed company, who will pass that ordinary resolution? You have to pass via postal ballot. And then after that, maximum 74% of the voting power can be held by equity shares with differential voting rights. After that, listen to me very carefully. There is point number four. What is point number four? Point number four talks about financial statement and annual returns for 3 consecutive years. There should be no default in filing for the 3 consecutive years. Okay. Point number five, sir, there is no subsisting default. You have no subsisting default in what, sir? In deposit, in debentures, in preference shares, in dividend, nothing. There is no default at all. And number six, there is no default in what? Some unique cases, sir, like in dividend to preference shareholder, dividend to preference shareholder, in repayment of term loan, in repayment of term loan, in statutory dues of employees, statutory dues of employees. And then point number four, guys, listen to me very carefully and try to by heart along with me. Statutory dues of employees and credit to IEPF. There should be no default. If you make a default, then what, sir? Sir, if you make a default, then you have to wait till the end of financial year and then for 5 more years. From the end of financial year till 5 years, you cannot issue DVR, but after that, you can issue a DVR. And so the point number seven is that you have not been penalized by any court or tribunal in the last 3 years. In the last 3 years, you have not been penalized under any act, RBI Act, SEBI Act, FEMA Act. You have not been penalized. In these cases, if seven conditions are satisfied, you can go and issue a DVR, not a problem. Sir, are you okay? Did you understand? Perfect, sir. Okay. Now let's move to the next part, sir. Please listen to me very carefully. These are the seven conditions. Now, listen to me very carefully. Number one, sir, a company cannot convert its existing equity share capital into DVR shares or DVR into equity share. Sir, normal share cannot be converted into DVR. DVR cannot be converted into equity share. Please remember that. Okay. After that, I said, sir, please understand equity shareholder and DVR shareholder will both have the same rights. Absolutely the same rights, sir. Sir, except for the voting power, maybe, except for voting power, all the other rights will be same. Like equity shareholder will also get notice of the meeting. Differential voting right shareholder will also get notice of the meeting. These are some things that you need to remember. Okay, guys. So that is that is section number 43. Now coming to next section, which is section number 46. Hello, hello, hello. So 44 and 45 is not there in our ICI module also, so you don't have to worry about. Although it is a very small section, but it is not there in our ICAI module. Okay. Okay. Okay, guys. Now moving to the next part, please listen to me very carefully, guys. What is section number 846? Section number 46 talks about certificates of shares, which is share certificate. So listen to me very carefully. What is share certificate? Sir, it says that shared certificate to be prima facie evidence. Whenever you get a shared certificate, it is a prima facie evidence of the title on such shares. Prima facie evidence. It is prima facie evidence. Now the question is, who shall authorize such share certificate? Sir, it will be authorized under a common seal or signed by two directors, or where the company has a CS, then a director and a CS. It will be signed by two directors, and if the company has a CS, it will be signed by a CS and a director. So basically common seal, two directors. If there is one CS, then CS plus a director. After that, guys, listen to me very carefully. If composition of board permits, sir, what if the composition of board permits? At least one of the two directors will be other shall be other than MDWTD. So we said two directors will sign. One will be MDWTD, but the other one will be any person other than MDWTD. Not a big deal. You remember this much only. After that, sir, my question is, can I get a duplicate share certificate? Yes, sir, you can always get a duplicate share certificate. What happened? If your original share certificate was torn, mutilated, or destroyed, for some reason it was defaced, mutilated, or torn, then in that case you surrender the old one and you get a duplicate one. But if it is lost or it is destroyed, like you don't have it, then in that case you cannot surrender, so you'll have to prove that it is lost or destroyed and you'll get a duplicate. So if there is a shared certificate, sir, I defaced it, for example, I spilled my tea on that shared certificate, then in that case I can get a duplicate shared certificate. Sir, what is the format of shared certificate? Please try to understand that the format of shared certificate is SH2. Sorry, the format of share certificate is SH1. Usually the format of share certificate is SH1. And sir, in what form will you get the duplicate share certificate? Sir, duplicate will also be in SH1 only, sir. The format will be same. After that, sir, the question is, when will you get a share certificate? What is the time period? What is the time period to get a share certificate? Sir, the time period will be, listen to me very carefully, in listed company, you'll get it just within 15 days of submission. But for an unlisted company, it will be within 3 months of the completion. For an unlisted company, it will be within 3 months. Give me a minute. Give me just 1 second. Sir, 1 second. Yes, sir. Actually, there is a correction in this amendment. ICI has made a correction. For listed company, it was within 15 days, but ICI has made a correction. It will be within 45 days. So basically, for listed company, it will be 45 days. For unlisted company, it will be within 3 months. Within 3 months, please make sure you write it down to be as 3 months. This will not be 45 days. This will be within 45 days. And for unlisted, it will be within 3 months. Within this many days, you'll get the share certificate. After that, guys, you will have to maintain a register of all the original share certificates that you gave, duplicates that you gave. You'll maintain a register in SH2. Where will you keep this register, sir? Whenever there is a question on register, where will you keep it? Registered or office or any other place as where the register of members is kept. Wherever you keep the register of members, there you can keep this register of share certificate. And in whose custody will it be? It will be in the custody of company secretary or any other authorized person. Are you with me? Yes, sir. Now coming to the last point, sir, what if a company issues a duplicate certificate with an intent to defraud? If a company is doing fraud by issuing duplicate share certificate, then sir, the company will be liable for minimum 5 times of the face value of shares involved and maximum 10 times or 10 crores, whichever is higher. 10 times or 10 crores, whichever is higher. Minimum 5 times, maximum 10 times of face value or 10 crores, whichever is higher. And the officer in default will be liable under section 447. What is section 447, sir? Sir, 447 talks about fraud. 447 talks about fraud. Are you with me? Yes, sir. Yes, sir. Okay, perfect. After this, guys, listen to me very carefully, sir. In case of joint ownership, also, there will be only one share certificate. You'll not get multiple share certificate. You'll just get one share certificate. Okay, okay, sir. So this is your share certificate. But you know, guys, after now in today's time, a public company or a private company, both of them are not allowed to issue share certificates. Shares are supposed to be in demat form. And in demat form, you do not issue a share certificate. Okay. After that, coming to the next section, which is your section number 47, which talks about voting rights. What is voting rights? Sir, voting rights is basically I'll keep it very simple for you. Sir, equity shareholders can vote in all the resolution. But preference shareholder, listen to me very carefully, equity shareholder can vote in all the resolutions. Preference shareholder can vote in only those resolutions in three types of resolutions. Number one, sir, number one, which directly affects their interest. Number two, when there is a resolution relating to winding up. Or number three, a resolution for repayment or reduction of equity or preference share capital. If in any these three resolutions, if it directly affects or winding up or repayment of capital, in these three cases, they pass a resolution. In these three cases, they vote in the resolution. But apart from that, preference shareholder cannot vote. But sir, if a preference shareholder is not paid dividend for 2 or more years, if you have not paid dividend to a preference shareholder for 2 or more years, then in that case, they will vote in that resolution also. They'll vote in that resolution also. This is section number 47, which talks about voting rights. This is section number 47, which talks about voting rights. Are you with me? Are you with me? Yes, sir. Sir, voting rights is equity shareholder can vote in all the shareholder. But if preference shareholders have not been paid dividend for 2 years or more, they can vote in all the resolutions as if they are equity shareholders. Okay. Now coming to section number 48, it's a very important section. Variation of shareholder rights. Please try to understand. Okay. What is variation of shareholders' right? Sir, if I had issued shares to these people and I said your one share will be equal to one vote. Now, all of a sudden, if I want to vary their rights and I want to say that, no, boss, for 5 shares, you'll get one vote. Sir, can you do this? Law says that you can do it, but only if your article or memorandum authorizes. Sir, number one, when you had issued these shares, you had not put any terms and conditions. When you had issued these shares, did you say that tomorrow I'll not make any changes? No, sir. So in case if terms and conditions of the issue does not stop you from changing it, you can change it. But you will have to take approval of the shareholders, right? So what is the process for variation, sir? Whenever there is a question on variation, there are 2 points that you need to address. One point would be how do you vary? How do you vary? Other point is what if there is resistance to such variation? What if there is resistance to such variation? What will you do in such case? Are you with me? Guys, are you with me? Yes. So, guys, how do you vary such rights? So, the variation can be done with the consent and writing of not less than three-fourth of the issued shares, consent and writing of three-fourth of the issued shares, or special resolution at a separate meeting. But variation can only be done if the provision for such variation is contained in AOA or MOA. It should be there in MOA or AOA, but in the absence of such provision, it is not prohibited by the terms of the issue. Make sure that your terms of issue do not prohibit such variation. If I want to vary from one share, one vote to 5 share, one vote, your terms of issue should not prohibit that variation. And number two, if possible, MOA, AOA should give you that authorization. If so, then you can go ahead and take consent or pass SR and you can make that variation. Sir, what is the difference between first and the second point? First point says that consent of not less than three-fourth of the issued share. Okay. Or SR. Sir, SR is also three-fourth. What is the difference? Sir, consent in writing of not less than three-fourth of the issued share means, hello, it means that, listen to me very carefully, consent of not less than three-fourth means that basically all the total shareholders that you have, of the total, you will take three-fourth shareholder. But in SR, sir, you will take three-fourth of only those shareholders who are present in the meeting. So, for example, it is possible that there are 100 shareholders. So, out of 100 shareholders, you will take consent of three-fourth, as in 75 shareholders. But if I talk about SR, for example, there are 30 shareholders present in the meeting. You will take three-fourth of this 30 shareholders for passing SR. So basically, there is a difference 100 shareholder and 30 shareholder. In general meeting, how many people are present? Out of that, you will pass SR. So which one is more difficult, sir? This three-fourth of total is more difficult. Okay. Understood. But listen to me very carefully. Sir, you will take consent of which class of shareholder? There is class A, class B, class C. If you are waiving the rights of class A shareholder, you will take the consent of just class A shareholder. You will not ask class B. You will not ask class C. But if variation of class A shareholder will affect the rights of class B also, then in that case you will take approval of class B also. But for them, there is no option of SR. For class B, you will have to take consent in writing three-fourth in value. Consent in writing of three-fourth in value. So it says that if variation by one class affects the right of the other class, consent of three-fourth of such other class shall also be obtained, and provision of the section shall apply to such variation. Provision of the section shall apply to such variation. Are you with me? Guys, are you with me? Yes or no? Yes or no? Yes, sir. Now coming to the next point, sir. What if there is a resistance? What if there is a resistance? Guys, please remember this is a revision, huh? This is a revision. I'm assuming that you have understood this concepts once, at least in the class, you have made some notes. Only then you will get 100% confidence. Sir, what is resistance to such variation? What is the meaning of resistance to such variation? For example, if a company asks the shareholders that can I make variation? Out of 100, sir, 80 shareholders agreed. So the variation was being made, but 20 shareholders still didn't agree. What about them, sir? Sir, they can go and make an application to the tribunal. How many people should go, sir? At least 10% of share capital. Shareholder holding not less than 10% of issued shares. At least 10% if they are holding and they did not consent, then they may apply to the tribunal for getting the variation cancelled. And now tribunal will pass an order, but until tribunal passes an order, nothing is going to happen. But when will you make such application, sir? Such application is to be made within 21 days of consent. Whenever that consent was provided, within 21 days you will go to the tribunal. And variation shall not happen effect until it is confirmed by the tribunal. Now tribunal has to confirm. Now, before tribunal confirms, company also cannot do anything. But once the tribunal has given its decision, it is binding on both the company also and shareholding also. The decision of the tribunal will be binding on both, and the copy of such order will be filed with ROC within 30 days. The tribunal's order copy you will file with ROC within 30 days. Sir, this is your section number 47. Are you trying to understand? I'll keep it again very simple for you. Section 48. Sorry, section 48. Section 48 talks about resistance. Sir, about variation. How can you vary the rights of the shareholder? Sir, if it should be authorized by MOA, AOA, or if it is not authorized by MOA, AOA, it should not be prohibited by the terms of the issue. It should not be prohibited by the terms of issue. If these two conditions are satisfied, number one, you will consent of 3/4 of the issued class, or you will pass an SR. Either this or that. After doing this, you will do the variation. Sir, SR of which shareholder? Only those relevant shareholders. Now, after that, what did I say? Sir, if variation is done by one class and it affects the right of the other class, then in that case, 3/4 of the other class, you will take approval of 3/4 of the other class also, but not SR, just 3/4 consent in writing. Now, if there is, can there be resistance to such variations, sir? Yes, sir. If at least 10% of the share issued class are not okay, they can make an application to the tribunal within 21 days of the consent and say that please get the variation cancelled. Now it is in the court the ball is in the tribunal's court. Tribunal can pass any order. The decision of the tribunal will be final and binding. The decision of the tribunal will be final and binding on both the people, on the shareholder also and on the companies also. Okay, guys. Moving to the next portion. Listen to me very carefully. Sir, section 49, 50, 51. What have we studied till now? 43, which talks about basics of kinds of share capital and DVR conditions. 44, 45 is not there. 46 talks about what? Share certificates. 47 talks about voting, who can vote. And 48 talks about variation. 48 talks about variation. Now 49, 50, 51. Listen to me very carefully. 49 talks about what? Sir, 49 talks about, listen to me very carefully. Sir, whenever you are making calls, for example, there is a class A of shareholder. Whenever I am making any further calls on such shares, sir, such calls shall be made uniformly for all the shareholder. I cannot say one shareholder you will pay 5 rupees and the other shareholder you will pay 10 rupees. No, sir. It has to be on a uniform basis. Calls have to be made on made on a class on a uniform basis. What is section number 50, sir? Section number 50 is important. Hello. Can a company take calls in advance? Can a company take calls in advance? Sir, a company can take calls in advance only if it is authorized by the AOA. But please try to understand, in the money that you paid as calls in advance, you will not get any dividend. If at all you will get some interest on such calls in advance, and such advance payment will not give you any voting rights also. You will not get any voting rights, but you can take calls in advance only if it is authorized by the article of association. Otherwise, you can't take it. Okay. Now, sir, question section number 51. Sir, can you tell me dividend is paid on what? Raja, dividend is paid on, listen to me very carefully, usually on the face value of the shares. Face value. But if you write down in the article of association, dividend will be paid up on the paid up value and not face up value. Dividend will be paid up on the paid on the paid up value and not the face value. Are you with me? Yes, sir. What did I say? I said that you have to understand this point. Three sections we studied together. What are those three sections? Sir, section number 49, 50, 51. The best way to remember this is UAD. In your income tax department, you have unabsorbed depreciation, right? Similarly, UAD. Calls to be made on uniform basis. What about calls in advance, sir? You can take only if AOA authorizes, and dividend, if you write in the AOA, it can be paid on the paid up share capital and not the face value. Otherwise, it is paid on the face value. But if you write in the article of association, it can be paid on the paid up share capital also. These are three sections: 49, 50, 51. Okay. Okay, sir. Now moving to the next section 52, which is very important. Listen to me very carefully. Sir, what is 52? Securities premium account, SPA. So whenever your issue price exceeds face value, whatever excess you have received, sir, you will put it in the SPA account. What SPA? You'll put it in SPA. If you have excess money, you put it in SPA. What's SPA, sir? Securities premium account. So excess money, whatever you have, you will put it in securities premium account. Now the question is, sir, what is the use of SPA? What is the use of SPA? What is the use or application of securities premium account? Sir, we are just talking about accounting entries. This question is also relevant for your account. 2 years ago, the application of SPA was asked in your accounts paper and not law paper. So listen to me very carefully. What is the use of SPA? There is 5 uses. Sir. Number one, you can declare fully paid up bonus shares. You can issue fully paid up bonus shares. Number two, you can write off preliminary expenses of the company. Number three, you can write off expenses or commissions paid or discounts allowed on issue of shares or debentures. If you're making any fresh issue and if there are any expenses, commission, discount, that also you can write off. So you can write off preliminary expense and issue expense. Sir, providing for premium payable on redemption of redeemable preference shares or debentures. When you're redeeming debentures or preference shares, you are paying premium, then that premium can be adjusted against your SPA, and the last one can be purchase of own shares, that is buyback. So, five use, sir. If you remember with me, it is bonus, buyback. You can issue bonus shares, you can buy back the shares. You can take care of the expenses. What expense, sir? Preliminary expense and for issue expense, right? Right. And the last one, you can provide for premium on redemption. You can provide for premium on redemption. Are you with me? Yes, sir. So these are the five conditions that you have to take care of. These are the five conditions that you have to take care of. These are the five usage of SPA: bonus, preliminary expense, issue expense, premium on redemption of preference shares or debentures, and the last one is buyback. But guys, listen to me. There are five usage, right? But if you are a company which is complying with the financials, which is making financial statement as per accounting standard under 133. If you are a company who is making financial statement as per accounting standard under 133, then instead of five use, you will get only three use. One, two, three you can do. One, three, five. These use you can do. Two and five you cannot. What was two and five? Remember, sir. Number one, bonus shares. Yes, sir, you can issue. Sir, writing off of preliminary expense? No, that you cannot do. Sir, issue expense write-off? Yes, that you can do. But premium on redemption of preference share? No, that you cannot do. And the last one is buyback. Can you do that? Yes, sir, buyback you can do. So for a company which is making financial statement as per accounting standard, in that case, instead of five, you will have three use. The second and fourth use will not be there. PP will not be there. What is PP? Write-off of preliminary expense and premium on redemption of premium on redemption of preference shares or debentures. Are you with me? So this is the usage of SPA. This is the usage of SPA. Okay. 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 Done. Perfect. Guys. Sir, before I move forward, I would want to request you that if you are enjoying this revision, do make sure that you hit the like button, because that is how I get to know that this revisions are helping you, because we put effort to make sure that these revisions actually do help you. If it is actually helping you, take a moment to write down in the comment and let me know how is it helping you, because honestly, your appreciation is my motivation and that is my inspiration that keeps me going. So if you're genuinely liking the video, let me stop here for a minute and ask you to make sure that you like the video. So once you like the video, let's take a very small target of this video, sir. We'll keep a reasonable target of, let's say, 100 students. There should be at least 100 likes in this video, and that is your responsibility. Okay, so make sure that we achieve the like target. And if you're genuinely enjoying the video, let me know in the comment, because again, as I said, your appreciation is what I need to bring more and more such revisions. To keep bringing more and more such revisions. Are you with me? Are you with me? Yes, sir. Okay. After that, guys, listen to me very carefully. Section number 53. Please, hello. So, what is section number 53? Section number 53 talks about prohibition on issue of shares at discount. Prohibition on issue of shares at discount. Okay. Prohibition on issue. Section number 53 and 54 we will read together. What is 53? Sir, 53 says that you cannot issue a shares on discount. But if you issue your shares on discount, it will be void. It will be void. That is, it will not be a valid issue. Sir, if it is void, you will have to refund the money along with the interest of 12% per annum. You'll have to refund such money along with interest of 12% per annum. And also you will have to pay a fine of up to the amount raised or 5 lakh rupees, whichever is lower. Whatever amount you raise or 5 lakh rupees, whichever is lower, that much fine you will have to pay. So you will have to pay a fine. So if a company shall not issue shares at discount, but if you issue it, it is void. You'll have to refund the money, you'll have to pay interest, you'll have to pay a fine. But now, guys, there are three exceptions to this. Three exceptions to issue at discount. In three cases, sir, you can issue at discount. What are these three cases? Number one, sir, the number one case is if you're issuing sweat equity share under section 54. We are studying 53. 54 is about sweat equity share. If you issue sweat equity share, you can issue it as a discount. What are the other two exceptions, sir? The other two exceptions are where you are issuing shares at a discount to the creditors when debt is converted into shares to the creditors in pursuance of any statutory resolution plan or debt restructuring scheme. So basically, the other two exceptions are your debt is converting into equity, and in that conversion, you are issuing it at a discount. Who said to issue at a discount, sir? Either a statutory resolution plan, a resolution plan. Resolution plan is under insolvency bankruptcy code. So because of that, either you are issuing at a discount or because of a debt restructuring scheme. So under these two schemes, if you are issuing at a discount because of conversion, then it is absolutely okay. But the major exception is, sir, sweat equity share. You can issue sweat equity share at a discount. Now, sir, let's move to section number 54, which talks about sweat equity share. Listen to me very carefully. Sir, what is sweat equity share? Pay your attention here. Sir, I'll give you a brief, then I'll make you read from the notes. Sir, basically, a company issues sweat equity shares to any of its directors or employees. Let me say employees. Okay. The sweat equity shares is issued to the employees in return of what? Sir, in return that you're getting some intellectual property rights, or you're getting some value additions, or you're getting some other intangible properties. You're getting some intellectual property rights, value additions, or other intangible properties. Now, because of that, you are issuing sweat equity share. Now, to issue sweat equity share, you will have to comply with certain conditions. Number one, sir, you will have to pass a resolution. You'll have to pass a special resolution. Okay. In that special resolution, you'll send the notice. In that notice, you will attach explanatory statement. In that, you'll explain all the things. To whom are we giving the equity shares? What is the price at which we are offering? What are we getting in return? Everything you will have to tell them. And if you're a listed company, then you comply with SEBI. But if you're an unlisted company, you comply with the company's rules. The company's rules that we have made. In the company's rules, we have told certain things, sir, such as, sir, the SR that you will pass, the SR that you will pass will be valid for 12 months. Within 12 months, you will have to issue the sweat equity share. Number two, sir, what do you mean by employees? Listen to me very carefully. If you can scribble along with me in a rough paper, nothing better, sir. Sir, what do you mean by employees? What is scribble, sir? You don't have to write with good handwriting or good notes. You just have to keep paying attention. Sir, what is employees? Sir, employees has been defined in the rules. Employees means, sir, full-time or part-time directors of the company. Directors of the company, whether full-time or part-time. Sir, employees of the company, whether in India or outside India. And third, directors or employees of the holding company and the subsidiary company also. Of the holding company and subsidiary company also, they will also be considered. So this is the definition of employee. Now, after that, what did I say? The validity of SR will be 12 months. Within 12 months, you will have to issue a sweat equity share. So there is some maximum limit of sweat equity share. How much can you issue? We will look at that limit in a while. But once sweat equity shares is issued, there will be a lock-in. What will be the lock-in, sir? The lock-in will be of 3 years. It is not up to 3 years or it is not minimum 3 years. It is just 3 years. Till 3 years, you cannot sell the sweat equity shares. After 3 years, you can sell the sweat equity shares. Okay. This is more or less the provision of sweat equity shares. Now read with me. Read with me, sir. There are three questions based on this, and it is an important section. So this is reference to the questions in the question bank. So you can simultaneously practice the questions from my question bank also. The questions from my question bank also, that also you can participate. Okay. 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 Yes, sir. Your class is very good and I understand it in English only, sir. Thank you so much. I'm so glad. That is the whole reason why I'm taking it in 100% English, guys. Listen to me. I said, sir, Such equity shares as are issued by the company to its directors or employees, such equity shares which is issued to directors or employees at a discount or for consideration other than cash. You're either getting giving it for free or for a consideration other than cash in return of know-how, intellectual property rights, or value addition. I'm giving you for a discount, I'm getting value addition, intellectual property rights, or know-how. In that case, it will be considered as a sweat equity share. After that, I said, what are the conditions, sir? Pass a special resolution. In the resolution, you specify the number of shares, the current market price of the shares, consideration, if any, and to whom are you giving it. You'll give all the details. And if you're a listed company, follow the regulations. If you're not a listed company, follow the rules. Okay, this is how you will issue sweat equity shares. Now, listen to me very carefully, sir. Sir, normal equity shares and sweat equity shares. What is the difference? Sir, in normal equity shares, you take normal consideration. In sweat equity shares, either you give it at a discount or you don't take consideration other than cash. You take consideration other than cash. But apart from that, there is no difference. All the rights that equity shareholders will have, the same rights that equity shareholders will have. Let me use a word. They will stand pari passu to each other. That is at the same level, at par, they will be pari passu to each other. They'll be pari passu to each other. After that, sir, what is the meaning of employee? Now we came to the rules. What is the meaning of employee? Sir, employee means a permanent employee, either in India or outside India. What's permanent employee, sir? Someone who is in the payroll of the company. Number two, sir, a director of the company, whether whole time or part time. Employee, India, outside India. Director, whether whole time or part time. And the last one, director or employee, covered above, for the subsidiary and the holding company also. For subsidiary and holding company also, those people will be considered as employee. Sir, what is value addition? Sir, value addition basically means economic benefits derived in future. Economic benefits that will be derived in future. That is value addition. Future economic benefits is value addition. After that, sir, some important points that you need to know. Sir, what is the validity of SR? It will be 12 months. The validity will be 12 months. Sir, next question. What is the maximum issue size per year? What is the maximum issue size per year? So maximum issue size will be, listen to me very carefully. Sir, it shall be not more than 15% of the equity share capital, paid up equity share capital, or 5 crore rupees, whichever is higher. So the limit is 15% of paid up equity share capital or 5 crores, whichever is higher. But in any case, sir, it shall not exceed 25%. But in any case, it shall not exceed 25% of the paid up equity share capital. And moreover, in case of a startup, which is in the first 10 years of its incorporation, the issue size will be maximum 50% of its paid up share capital. Oh my goodness, what the hell is this limit, sir? Let me explain this limit to you. Listen to me very carefully, guys. Sir, I said 15% of paid up equity share capital or 5 crores, whichever is higher. But it can be maximum 25% of paid up equity share capital. My question is, sir, when whichever is higher is written is maximum 15%, then how can it become 25%, sir? Why is there one more limit of maximum 25%? I'll give you an example. Sir, if my paid up equity share capital is 10%, 10 crore. What is the 15% of this? 1.5 crore. Or 5 crore, whichever is higher. What is higher? It is 5 crore. So law says that I can issue equity shares, sweat equity shares up to 5 crore. But boss, wait. It is 50% of the paid up equity share capital. But maximum can be how much? Maximum can be 25%. So the other limit is 2.5 crore. It cannot exceed 2.5 crore. So there are two limits. Limit one, subject to a maximum of 25%. But if it is a startup company, sir, which is in the first 10 years of its business. For startup, we always give exception for 10 years. In that case, instead of 25%, it will be 50% of paid up share capital. For them, it will be 50% of paid up share capital, not equity share capital. 50% of paid up share capital. Paid up share capital. Are you with me, sir? This is the limit that you have to understand. Okay. Okay, guys. Now listen to me very carefully, sir. What is the next point? Sir, what will be the lock-in? Sir, the lock-in will be of 3 years. What will be the lock-in? The lock-in will be 3 years. It is absolutely fixed. You cannot have a lock-in of 5 years. In exam, there was a question asked that can the lock-in be up to 5 years? Students started writing, yes, sir, 5 years is allowed, 3 years is minimum. No, it is fixed at 3 years. You cannot have a lock-in of 5 years. After that, sir, who will do the valuation? So if I'm giving you equity shares, I'm getting something in return. Who will do the valuation of that thing? Sir, in Companies Act, every valuation is done by the registered valuer. After that, listen to me very carefully. Sir, valuation will be done by registered valuer. And what will be the treatment? Accounting treatment. How will you do the accounting treatment, sir? Sir, when I am issuing equity share capital, I will make credit to equity share capital. But what will be the debit account, sir? What will be the debit account? So the debit account will depend. If I'm getting some asset, if I'm getting some asset that can be depreciated or amortized, then debit the asset in the balance sheet. But if I'm not getting any asset, then I'll debit P&L account. Then I'll debit P&L account. So this is not relevant for our law, but just a simple accounting entry. What will you debit? You will debit what you are receiving. So what are you receiving? If it is an asset, send it to balance sheet. If it is not an asset, put it in the P&L. Put it in the P&L. Okay. After that, sir, you will have to maintain a register of all the sweat equity share, and that register will be maintained in form SH3. Register will be maintained in form SH3. Are you with me? Hello, hello. Are you here? Can you hear me? Sure. Understood. Understood. Yes or no, sir? Yes, sir. So now coming to the next section, section number 55. I want you to take a deep breath for those who are watching continuously. I want you to take a deep breath. See, please try to understand. First, I am explaining you the provision broadly, and then we are reading each and every point. So this is a good enough revision and more than enough for your last day revision. You don't have to revise more than this in your last day revision also. All you have to do is keep listening to this revision videos multiple times. If you're working also doing something else also, you keep listening to this revision audio and a revision video, and you'll get a lot of comfort. Are you with me? Yes, sir. Okay. Okay, sir. Let's move to the next section. Please listen to me very carefully. Sir, section number 55. What does section number 55 talk about? Section number 55. Here you go. Section 55. Sir, first take a brief context and then we will deep dive into the details. Guys, hello, 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 sir. What is section number 55? Section number 55 talks about preference share capital. Point number one, sir. Preference share capital can only be redeemable. It cannot be irredeemable. You have to definitely redeem preference shares. Sir, what is the limit time period within which you have to redeem? Sir, it can be redeemed within 20 years also. But in some cases, it can go up to 30 years. Which cases, sir? In infrastructure companies, it can go up to 30 years also. But for infrastructure companies, there is one condition that after the end of 20 years, from the 21st year, they will have to keep 10% option for redemption. Each year, they will have to keep 10% of the preference shares for redemption, 21st year, 22nd year. That like that, they can redeem up to 30 years. But only for infrastructure companies, we have given 30 years, sir. Okay. Now, point number three, please try to understand. Whenever you are issuing a preference share, okay, and whenever you are redeeming the preference share, the question is what will be the source of money? How will you redeem the principal amount and how will you redeem the premium amount? How will you do that? So, source is a question that we will understand. And after that, the fourth and important question that we will understand is deemed redeemed concept. This is something that students face a lot of confusion with. I will explain it very nicely. But deemed redeemed, what is deemed redeemed? Okay, you will have to put efforts to understand in one go. Just that you will have to put efforts to understand in one go. Otherwise, you will not be able to understand. Okay, sir. Let's begin. Sir, what is section number 55? Listen to me very carefully. Sir, section number 55 talks about redemption of preference shares, issue and redemption. First of all, company can issue only redeemable preference share. It cannot issue irredeemable preference share. It can only issue redeemable preference share. Number two, sir, condition for issue of preference share. Sir, preference share shall be authorized by the AOA. Article of Association will authorize it. Number two, it has to be passed. You have to pass a special resolution. Number three, there should be no defaults with respect to redemption of any earlier preference share or payment of dividend on such preference share. Sir, if I have not given money for one preference share, how can I issue one more preference share? I cannot. So, Article of Association has to authorize pass SR and there should be no default. Number four, such preference share is redeemable within a period not exceeding 20 years. Such preference shares is redeemable within maximum 20 years. But however, it can become 30 years in case of companies in infrastructure projects, provided that from 21st year onwards, minimum 10% will be redeemed each year at the option of the preference shareholder. So the company will have to offer at least 10% each year for redemption. So basically, these are the four conditions that you have to take care of. After that, guys, redemption of preference shares, please listen to me very carefully. Sir, redemption of preference share only be in terms on which it is issued or varied. Okay. Sir, please listen to me very carefully. Come to the third point. What is the source of redemption? How will you get the money, sir? It can be either the profits of the company available for dividend or proceeds of fresh issue. Sir, what is proceeds of fresh issue? You can you can issue fresh preference shares, take that money and redeem the old preference shares. Okay, so either profits of the company or proceeds of the fresh issue. The next one is only fully paid up preference shares can be redeemed, other cannot be redeemed. So the what did we study first? What is the condition for issue and what is the source of redemption? So source of redemption is profit or proceeds of fresh issue. But sir, what about the premium part? What about the premium? Listen to me very carefully. Sir, what is the source? The source is profit or proceeds of fresh issue. But sir, if you are using the profits of the company to redeem preference share, in that case, you will have to create something called as CRR account. CRR will be created for how much? For the nominal value of the preference share redeem. Nominal value. This CRR can be only used for issue of bonus shares. So you will have to create a CRR if you are using your profits for redemption. And CRR will be only up to the amount of nominal value, not the premium. And that CRR will only be used for bonus shares. Okay. Now, sir, what about the premium on redemption? If there was a preference shares of 100 crores and I'm redeeming 120 crores, where will I get that extra 20 crores from, sir? Sir, do you remember SPA? Securities premium account. There were five views: bonus, right of preliminary expense, right of issue expense. Point number four, for providing for the premium on redemption of preference shares or debentures. So you can either use the profits of the company or you can use SPA. You can either use profits of the company or you can use SPA. But sir, do you remember in section 52, there was a point that if a company is making financial statement as per accounting standard, instead of five uses, there will be three uses. Two use they cannot do. What were those two uses? They cannot write off preliminary expense and they cannot provide for premium on redemption of preference shares. So that is the same point here, sir. Sir, for premium, you will generally use profit or SPA. For premium, you will generally use profit or SPA. But in case if the company complies with the accounting standard, then for premium redemption, you can only use profit. You cannot use your SPA. Okay, these are more or less the things that you have to understand, sir. Now, after that, what is deemed redeemed? But before deemed redeemed, let me give you a hold of the concept. What is section 55? Listen to me and do you understand these points? Number one. Okay, say okay. Number one. Sir, preference shares can only be redeemable, it cannot be irredeemable. Number two, there are four conditions for issue of preference share. Number one, AOA. Number two, pass special resolution. Number three, ensure that there is no default in existing preference share. And number four, the tenure can be 20 years. Sir, but for a company which is an infrastructure project, the tenure can be up to 30 years. But one condition that from 31st year onward, you will have to provide 10% of preference shares for redemption at the option of the preference shareholders. In that case, you can take up to 30 years. Point number two over. Coming to point number three, what will be the source of redemption, sir? Source of redemption will be the profit of the company or proceeds of fresh issue. Proceeds of fresh issue. But if you're using the profits of the company, you will have to create a CRR up to the of the nominal value of redemption, and that CRR can only be used for bonus shares. Point number four, what will be the source of redemption of what will be the source of the premium amount? It can be the profit or the securities premium account. But in case if a company complies with Indian accounting standard, then SPA cannot be used. You will only have to use profits of the company. Okay. And the last point, what is the concept of deemed redeemed? Listen to me very carefully. Sir, what is the concept of deemed redeemed? Hello. Sir, if I had issued my preference share for 20 years and close to that, when I'm on the 19th year, I'm realizing that I cannot redeem the money. I don't have the money to pay the preference shareholders. But you also don't want to default because once you default, there will be a lot of problems. Like you cannot issue differential voting right shares. You cannot issue fresh preference shares. There will be a lot of problems. So what can I do, sir? Can I ask for extension? No, sir. In preference share, there is no option of extension. So there is one option that the company can first take approval of the preference shareholder. First take approval consent of the preference shareholder. How much consent, sir? Let's say 75% shareholders consent. And then take approval of the tribunal. And the company will make an application to the tribunal and say what? Say that, sir, can I issue a fresh, can I issue fresh preference shares to the same preference shareholders? And once tribunal allows you to issue this fresh preference shares, the older preference shares will be deemed to be redeemed. Deemed to be redeemed, as in if we will assume that what happened. For example, you, and I am the company, you are a preference shareholder. For example, you had given me 1 crore and I'm not able to repay that money. So I'll go to the tribunal. If tribunal gives me approval, then what will happen? Sir, the 1 crore that I'm not able to give you, what will happen with that? It will be assumed that I have given you that 1 crore back, and again you have invested that 1 crore in my company. I have repaid it to you, so there is no default, and you have given me fresh 1 crore rupees to continue. Sir, in reality, no transaction will happen. In reality, neither will I give you 1 crore nor will you return that 1 crore because I don't have that 1 crore only. I don't have money to redeem only. So, in reality, no transaction will happen. In reality, only accounting entry will happen. Sir, in reality, you will show that this preference shares that you had issued, let's call it preference shares 1, you will assume that this is redeemed, and instead of this, preference shares 2 has been issued. Although practically nothing has happened, sir, practically the same has just continued. The same has just continued. Why are you doing this? Because you don't have the money to repay, sir. And even your shareholders have given consent. But, sir, what about those preference shareholders who have not given consent? Sir, for those preference shareholders who have not given consent, the company will have to redeem this forthwith. Redeem this forthwith, as in you will have to immediately refund the money. You will have to immediately refund the money to those shareholders, to the dissenting preference shareholder who did not give their consent. Okay. Listen to me very carefully. So read with me. Where a company is not in a position to redeem the preference shares or to pay the dividend, it may, with consent of three-fourth in value of preference shareholder, you have to first convince three-fourth of preference shareholder in value. Make an application to the tribunal for approval, and thereafter issue further redeemable preference shares to the amount of unredeemed preference shares and the dividend thereon. And on such issue, unredeemed preference shares shall be deemed to have been redeemed. So read this again. Once you read this yourself once read this paragraph properly. You have understood that. Based on that understanding, please read it. Done. Done are done. Okay, sir. Now coming to the next point, guys, listen to me. Lekin provided that tribunal shall order redemption forthwith of preference shares held by persons who have not consented to issue of further shares. So the people who said no, that 25% people who said no, they will get forthwith redemption. That is immediately money will be refunded to them. But for the other people, fresh issue will be made and the older issue will be deemed to be redeemed. It will be assumed as if you have redeemed that older issue. Okay, guys. Okay, sir. So this is your section number 55. We have done it very nicely. Now let's move to the next section, which is 56, 57, 58. Okay. Easy sections, not very practically important, but first of all, you understand it in the form of story, and then we will get into the details. Okay. So what is 56? 56 talks about two things. 56 talks about two things. There is something called as transfer of shares, and there is something called as transmission of shares. Try to understand, sir. Try to understand. Pretty sure you must have not understood so much in any other regular classes also, the way you will understand now. Sir, what is transfer of shares? Sir, transfer of shares is basically if Mr. A wants to transfer his shares to Mr. B, so they will enter into a deed. They'll enter into a deed which is called as transfer deed. So transfer deed will contain all the information of Mr. B. Okay. And both of them will sign it. Okay. Now Mr. A or Mr. B, any one of them can go to the company within 60 days. Within 60 days, they'll go to the company. That boss, we have made a transfer. You kindly record this transfer in your register of member. Now, what the company will do? In the register of member, Mr. A name will be written. That will be removed. And instead of that, Mr. B's name will be written. And after that, a shared certificate will be issued to Mr. B. So this type of transfer used to happen way back, way earlier. Now there is no instrument, nothing. Now it is instant transfer through Demat account. But in older times, this is how transfer used to happen. But sir, this is what transfer is where you are doing with your own will. right? What is transmission, sir? Transmission is something which happens because of operation of law. What do you mean? Sir, if Mr. A died, his shares will be transferred to Mr. Small a. Mr. Small a. So Mr. Small a, who is the son of Mr. A, got the shares of Mr. A because of transmission, that is death. So transmission is something which happens by operation of law. It is not manually done. It happens automatically because of law. Now there are certain things that you have to understand, sir. First of all, case number one. Sir, in transfer, when A made transfer to B of partly paid up shares, that is, in 100 rupees shares, assume 60 rupees is paid and 40 rupees is unpaid. Now, if the shares becomes in the name of B, if the shares is transferred to B, B has to pay the remaining 40 rupees. Now, imagine a situation. They entered into an agreement. It is instrument deed. Okay. If B goes to the company and says, hello, I have purchased shares from Mr. A. Kindly remove the name of Mr. A and put my name, Mr. B, and transfer the shares in my name. Company will not have any problem because Mr. B himself is saying that I will pay the remaining 40 rupees. But sir, if instead of Mr. B, in this case, if Mr. A goes to the company, if Mr. A goes to the company and says, Mr. A goes to the company and says, I have sold the shares to B. You register it in the name of B and B will pay you 40 rupees. Sir, in that case, company will not register directly. Company will send a notice to Mr. B and Mr. B has to reply to that notice whether that shares has to be transferred in his name or not. So Mr. B will have to reply to that notice only when Mr. B confirms that yes, I have purchased the shares and I'll pay the remaining 40 rupees. Only in that case, company will register. Otherwise, the company will not because this is a case of partly paid up shares. In case of fully paid up shares, there is no such problem. But in partly paid up shares, there is definitely a problem. Coming back to transmission, sir, transmission is because of operation of law. Now tell me something. Mr. A died. The shares got transferred to Mr. Small a. Now who will go to inform the company, sir? Will Mr. A go and inform? Mr. A is dead. Can he go and inform? Sir, if he goes and inform to companies, all the members in the companies will die. Because what? His soul will go or what? So Mr. A cannot go and inform. Mr. Small a will go and inform to the company that please register in my name. Now I have a question, sir. On 1st of March, Mr. A died. Mr. Small A informed the company on 15th of March. Now company will take at least 30 days, sir. Company will take at least 30 days. Company will take at least 30 days to inform. Company will at least take 30 days to change the register of member from where Mr. A's name will be removed and Mr. Small A name will be kept. So company will take 30 days. Now my question is, before it got transferred in the name of Mr. A, Mr. A sold these shares to Mr. GF, Miss GF, to Miss GF. Small A sold his shares to Miss GF. My question is before transmission, before his name came in the register of member, can Mr. A sell his shares to anybody? So the answer that came was yes. Sir, although in the register of member Mr. A's name is yet to come, but please understand after death of Mr. A, the son Mr. Small a has all the rights. The small Mr. A has all the rights immediately on 1st March itself. So now, if he wants to transfer it, he can transfer. No one is going to stop him. Law is not going to bother him. Law is not going to bother him. Are you with me? Yes. Yes, sir. Yes. Then please come and read the keywords along with me. Okay. Sir, what is section number 56 talk about? Section number 56 says that if there is a transfer, there has to be a proper instrument of transfer. That is, as I called as agreement. Instrument of transfer in SH4. Duly stamped and dated. It has to be stamped and dated. Such instrument specifies the details of the transferee, Mr. B in my example. And such instrument has to be delivered to the company within 60 days of execution. You have to give it to the company along with the share certificate or letter of allotment. If there is no share certificate, you give the letter of allotment, but you go to the company within 60 days. So these are the three things. After that, what did I say? Listen to me very carefully. Sir, coming to transmission. What is transmission, sir? Sir, transmission happens by operation of law. And in this case, the transmission, in case of transmission, intimation of the same is to be done by the transferee. The son has to go and intimate to the company. When does transmission happen, sir? In case of death, the share goes to legal representative. Sir, in case of insolvency, the share goes to resolution professional. RP, resolution professional. In case of lunatic, in case you become mad, in that case, it will go to administrator appointed by the court. So death, insolvency, and lunatic. Dil, dil, death, insolvency, lunatic. Dil means heart. Okay. What about partly paid up shares, sir? You remember I was talking something about partly paid up shares? Yes, sir. When an application for registration of partly paid up shares is made by the transferor alone, Mr. A alone went to the company and said, I have sold it. In that case, the company shall not register unless company has given notice in form SH5 to the transferee. Company has to inform the transferee, and transferee gives no objection within 2 weeks. The transferee have to give no objection within 2 weeks. Only if the transferee says, I have no problem, you register. Only then the company will register. Otherwise, the company will not register. So how much time have we given, sir? Very interestingly, we have given 2 weeks. Okay. Hold on point number 4. Come to point number 5. Sir, what is point number 5? Sir, it says transfer of any securities of a deceased person made by his legal representative. I gave you an example that after death you are transferring the shares even if the legal representative is not a holder. Why is he not a holder, sir? Because in the register of member his name has not yet been registered. Such transfer shall be valid as if the holder, as if he was a holder at the time of execution. It will be valid as if he was a shareholder itself. So, for example, Mr. Father died. Mr. Son transferred the shares. Even if his name was not there in the register of member, it will be fine because it is valid transfer, sir. It is a valid transfer. And if you make any contravention, the company and officer in default will have to pay a fine of 50,000 rupees. They'll have to pay a fine of 50,000 rupees. Are you with me, sir? Yes, sir. Now, the fourth point that I had left, sir, in the coming back to the case of transfer here, Mr. A gave his shares to B. B went to the company. Company registered such transfer and issued share certificate. The question is, B or A has to go within 60 days of execution. But how much time will company take to give us the share certificate, sir? How much time will the company take? Sir, the law said, in case if you're a subscriber to the memorandum, that is your first time shareholder, you'll get it within 2 months of incorporation. But if it is a case of allotment, like for example IPO, FPO, etc., you'll still get within 2 months of allotment. But if it is a case of transfer or transmission, you'll get it within 1 month of receipt of such deed. So whenever the company will receive this deed, whenever the company will receive this deed within receipt, 1 month they will have to give. Only in case of transfer and transmission. So generally it is 2 months, 2 months, but for transfer it is 1 month. And for debentures, it is 6 months from the date of allotment. In debentures, so it is very slow. But this is for physical share certificate. In case of demat account, everything happens immediately, sir. You don't take so much of time. Everything happens immediately. Are you with me? Yes, sir. Did you understand? Did you understand? Now I'll also cover one question which is asked in the exam, sir. It was not there in your ICI module, but I'll cover it here only so that you can solve each and every question of your question bank. My question is, sir, I'll keep it very simple for you. Sir, if Mr. A had shares of Reliance Industry, someone forged the shares of Mr. A. Who forged, sir? Let's say Mr. X forged the shares of Mr. A and then transferred it to Mr. B. Then Mr. B transferred it to Mr. C. This was a proper transfer, sir. C was a proper transfer. Mr. C paid consideration. Mr. C paid enough money. And Reliance Industry first had the name of Mr. A. He removed it, put Mr. B's name, then removed it, put Mr. C's name. Once this forgery and transfer was done, Mr. A got to know, oh shit, my shares have been transferred. Someone stole my shares. So Mr. A went to Reliance. Will Reliance have to restore his name? Will Reliance have to restore his name? The answer is yes. Yes. Sir, the court held that forgery is nullity. Like forgery is nullity. If Mr. A's shares were forged, it is not a valid signature. You cannot make such transfer. So in this case, Reliance will have to return the shares to Mr. A. Reliance will write down the name of Mr. A, and Mr. Reliance will not be liable to Mr. C. Reliance will not be liable to Mr. C. Reliance is not answerable to Mr. C. Reliance will restore the name of Mr. A. What will Mr. C do, sir? Mr. C will file a case against Mr. B. What will Mr. B do? Mr. B got cheated. So Mr. B has to chase this Mr. X, otherwise it is loss of Mr. B. But sir, I have a question. Sir, Mr. B said proper consideration. Mr. C purchased in good faith. Then what is the problem? If you give adequate consideration and if you purchase in good faith, then it is a valid transfer. But sir, please remember you studied in your foundation that the the rights of the transferee, the title of the transferee is as good as the title of the transferor, or the title of the buyer is as good as the title of the seller. Here, sir, the title of seller, which is Mr. B, this title is only defective. That is why Mr. C's title is also defective. You cannot pass a better title to the buyer. You can always pass the same title to the buyer, and your title is defective, and therefore you have no rights. You have to chase this person who forged it. That's why Mr. A will win, Mr. B and C will lose. Okay. Moreover, in between, if you have also issued any bonus shares, that bonus shares will also go to Mr. A. Any dividend or any bonus, that also will be restored to Mr. A. Did you understand, sir? That is a question. I have summarized that question and the answer here, but we don't have to read this because I already discussed this with you. Okay. Sir, what is section 57? We'll read it for the purpose of reading it. Sir, punishment for personation. Just understand that what is personation. If you are trying to act as if you are someone else. For example, I went to Reliance and I'm acting as if I'm Mukesh Ambani. It is personation of Mukesh Ambani. So if I'm doing personation of any person, then in that case, I'll be punishable with a jail of 1 year to 3 years and with a fine of 1 lakh to 5 lakhs. 1 year to 3 years and 1 lakh to 5 lakh. 1 year to 3 years and 1 lakh to 5 lakh. 1 year to 3 years and 1 lakh to 5 lakhs. This will be the fine. Okay. Done. What you are talking in Telugu or what? నాకు కూడా తెలుగులోని మాట్లాడడం వచ్చు కొంచెం కొంచెం తక్కువ. Listen, sir, the last section for the day and then we will end the class. The last section for the day and then we'll continue in the next class. Listen to me very carefully. Sir, section number 58 which talks about refusal to registration and appeal for refusal. Sir, simple thing. If A transferred the shares to B and A or B went to the company and said, please remove Mr. A's name and put Mr. B's name. And if the company is saying, no, I will not do it, then what can Mr. A or Mr. B do? Okay. It depends on whether this company is private company or public company. See, boss, in public company, shares are easily transferable. So you should definitely register that transfer. So in public company, if you're not doing, we can take action. But in private company, if you're not doing, we can take action, but within a limited time period. Okay. How does it work? Listen to me very carefully. Sir, if a private company refuses to register the transfer, then in that case, within 30 days of the delivery of transfer instrument, they should give a notice of refusal. They should give a notice of refusal, stating the reason for refusal as to why are they saying no. So we will give the instrument to company. Company will send us a notice of refusal within 30 days. Now, after that, after receiving the notice of refusal, if we are not satisfied, within 30 days, we will file an appeal to the tribunal. We'll file an appeal to the tribunal as to see, boss, this private company is not registering it. Within 30 days of the receipt of notice of refusal. But if they did not send the notice of refusal, then from the date you had delivered that instrument, within 60 days, you will go and file the appeal. So, for example, sir, this is the date on which instrument was delivered. So, from within this days, within 30 days, they will send notice of refusal. And whenever they send notice of refusal, within 30 days, you will file an appeal. But if they did not set notice of refusal, then within 60 days from delivery, you will file an appeal. It's the one and the same thing. Okay. This is in case of a private company. But what in case of a public company, sir? In public company also same. Sir, you will deliver the instrument and within delivery, within 30 days, they will give you notice of refusal. And after that, within 60 days, you can go and appeal. Not 30 days, 60 days. But if they did not give you a notice of refusal, then within 90 days, you can go and file an appeal. Within 90 days, you can go and file an appeal. So for a public company, the only difference is we have given you 60 days to file an appeal instead of 30 days here. Instead of 30 days in case of private company. So you will go and file an appeal with the tribunal. Then what will the tribunal do, sir? Sir, the tribunal will either accept your appeal or dismiss your appeal. If they accept your appeal, what are the orders that the tribunal will pass? Sir, the tribunal can say that it may direct the company to register the transfer or transmission and the company will have to do it within 10 days. So the tribunal will say, hello, please register it. And the company will have to register it within 10 days. Or direct the rectification of the register and also direct the company to pay the damages. If there is any problem with the register, They can say that rectify the register, and the company will also have to pay the damages. If someone had incurred losses, if someone has incurred losses, then that also you will have to bear. Sir, what is the contravention? The contravention is imprisonment 1 year to 3 years and fine 1 lakh to fine 5 lakhs. If the company does not comply with the provision that the tribunal said, then 1 year to 3 years and fine 1 lakh to 5 lakhs. Okay, so this is your section number 58, which talks about refusal to transfer. 59 is something which is same as what we studied. It is absolutely same. So you can read that. Tomorrow in the next class, we will start 61. Very important provision, sir. We will read alteration versus reduction. We will read buyback, and we will read debentures also. Very important provisions we will cover in the next class. Super important class, sir. Very important chapter and super important class. Okay. Now, for those students who have watched till here, I want to tell you one message before I end the class. Sir, I always tell you this thing and I'll always keep telling you, deserve before you desire. What do you mean by deserve before you desire, sir? Deserve before you desire means basically you have to become more before desire. Deserve before you desire means what? For example, each one of us want to clear our exams, sir. Each one of us want to get a rank. Each one of us want to get a both group clear in one attempt, and if we are giving one group also, we want to clear. But these are our desires. In order to get what we want, we have to first become deserving. We have to first become deserving. How do we become deserved, sir? With a lot of efforts into our studies. We have to put a lot of efforts into our studies. We have to study day and night. We have to take care of our mental health, and we have to keep studying every day to make sure that we are giving our 100%. So first you become deserving of the success, and once you deserve that success, all your desires will be fulfilled. Okay. If you have enjoyed the revision till here, I want you want you to write down one message in the comment box, and that is, I will give my 200% in this exam. I will try. I said that I will give my 200% in this exam. This is something that you should write in the comment box. Okay. And I'm sure that you're going to do very, very well. A lot of code revisions will keep coming. This code revision playlist is being made and you're going to love it. Okay. So do make sure that you take the best out of this code revision. And I'll see you in the next video. Until then, study well, keep going, take care. This is your CA buddy Shubham Singhal signing off. Bye bye.